through this webinar and some of the insights that we'll be talking through. So for the audience, my name's Soren Reichelt and I head up digital here at Tsimos. So my role is really to facilitate the process and use these great platforms like webinars and blogs and bits and pieces to communicate out with our audience and with our clients and potential customers as well. So today's webinar is Insights You Need to Know as a Commercial Property Landlord in Today's Market. We worked on preparing this webinar to really provide a bit of an overview, I guess, for commercial property landlords, given the year that we've had. And Steve, I think it's almost to the letter now a year in terms of when we first started having indications of COVID entering the market in Australia.
In fact, Soren, happy anniversary to you and to all of us, because today is the anniversary to the actual day when Daniel Andrews announced the state of emergency for the COVID-19 pandemic.
It's been a year.
Exactly a year to the day.
I think it's been a long year too.
It's been a challenging year, but you know, it's life's full of challenges, and it's a question of how we deal with them and how we then look to the future.
Absolutely, absolutely. So look, let's get into this, guys. One thing I wanted to say is we are going to be running a fair few webinars in this series. So most of you would have received an invitation for this webinar through your email. Certainly keep monitoring that, because we are running some other webinars in different topics as well. If there are any topics that you were looking for us to focus on, or any questions that you had, please feel free to send them through to that email, digital@tsimos.com.au. We review that as a team and then produce the content and push that out and notify the audience. So we'll also share a recording of this webinar post. But let's kick into it, Steve. So look, Steve, I guess the first part, because probably some people on this webinar, we've got a few attendees today that might not know much about yourself and the Tsimos business. I see the lead point here, 34 years in commercial property. You would have seen a fair bit of change over 34 years. Talk us through some of that change and a little bit about the Tsimos business as well.
But the biggest change in 34 years has gone from pen to paper to carrying around a computer in your hand. So that's the technology's obviously been the biggest change, I think, in not only in real estate but any industry over the last 30 years. You know, I founded the business some nearly 35 years ago, actually. And you know, from a very, very small base, we've built a relatively medium-sized business and a long-standing client base, and you know, just an amazing team which I work with. I'm incredibly and extremely proud of, and I get up in the morning and I look forward to coming to work just to say hello to my team.
That's fantastic. Now, Steve, we were talking about this the other day. In those 34 years, you've seen, I guess, different recessions, different economic downturns in that time. And for this webinar, we're really focused around COVID. What sort of commentary do you have in terms of the recessions that you've seen in the past and the recessions that we believe we're experiencing now?
Look, I think the one thing we need to understand is that an economic recession in general terms is a downturn in economic output, in GDP, in demand and what have you, due to economic factors. The COVID-19, and I don't like to use the word recession, but the public or the journalists do, it's not a recession per se. It's a downturn in business due to a lockdown, due to people having to have shut their doors and stop operating and stop income. So it's not an economic downturn. Underlying the COVID pandemic and prior to it, the economy was solid, the economy was strong, and activity was very, very, there's a lot of activity in the marketplace. But when you shut down, that is going to force people to obviously lose money and not make an income. So it's a totally different scenario to an economic recession. And in an economic recession, you often have interest rates rising prior to that. But in our case, of course, interest rates have been dropping before and since the COVID pandemic started.
Yeah, and obviously that, the confidence, we've seen it, week on week, it changes a lot out there in the market, but we've seen that confidence start to return. I think if you're asking a lot of people, just even in residential, towards the end of 2020, it was potentially doom and gloom around this point, but we're seeing certainly high prices in those areas and growth in those areas as well, money being very easy to access.
Yeah.
And in today's webinar, we want to talk a little bit about those other investment opportunities and things that are happening in commercial as well to round out that conversation. I think residential gets a huge play on the media or through the media, but commercial, this is what we're going to be talking through today.
Yes. And
Fantastic.
just want to acknowledge Patrick's greeting. Good morning to you too, Patrick.
Thank you, Patrick. Fantastic. All right. So, look, Steve, I guess thank you for taking us through a little bit about Tsimos. Now, um, really at an industry level, what impact did COVID have on the commercial property industry? So, from your business perspective, the team, I mean, we know a lot about the different industries, retail and bits and pieces, and the impact that's had. But specifically to your business, I mean, what was really the big impact that you saw?
Well, other than the obvious, which was a decline in income, it was the actual workload on the staff. It wasn't just simply managing a property in terms of collecting rents and outgoings and lease renewals and rent reviews, but we had to negotiate with very, very many tenants and landlords in terms of the rent relief that the state government legislated under the COVID-19 Omnibus Act. So that workload, was enormous, and particularly having to have done it in the most part remotely,
Yeah.
difficult and challenging. But look, hats off to my staff, and I'm sure many other companies in my position would say the same thing, because they've managed it remotely and they've managed it since we've been back very, very well, and now we're sort of coming out of it. And in fact, I would suggest to you that more than 90% of our tenants now are back paying full rent.
Yeah, I mean, and that's extremely encouraging given um, the different ways that could have played out.
Oh,
It's
absolutely it
it's
is. I mean, back in March last year, we were going into uncharted territory. We had no idea where this was going to go and no idea how business was going to suffer.
yeah.
But we've learned a lot. And I think coming back to the technological aspect of it, we've learned now that you can work remotely. And I think that's going to affect real estate, certain sectors of real estate going forward as well.
Yeah, and I think we'll dive into a little bit of that. I mean, even just using things like webinars, which we're doing here at Tsimos,
Yeah.
as a new communication medium. I mean, these things probably prior to the pandemic, maybe some people weren't really a fay with the idea of video conferencing, but I think most of Australia has now used these sorts of tools to communicate. So it's interesting at an industry level what's happened, but also more broadly some of those market shifts that have happened as well.
Yeah.
Yeah, fantastic. All right. Well, look, I think, Steve, one of the things that we wanted to really talk through today was to look at the different um, asset classes and really look at, I guess, which of those sectors were impacted the hardest. Now, one thing that I wanted to do was really just launch a bit of a poll for the audience so they can give us their feedback in terms of which sector you believe or which asset class or class were hit the most during the pandemic. So you can select an option there. Um, we've got office
Yeah, it'll be
space,
interesting to
retail.
see. I've got my ideas, and I'm sure um, everyone will have their own, but it'll be interesting to see if anybody agrees with me.
Yeah, last week we had, because well, 2 weeks ago we ran the first one of this, we had a really interesting um, result, very aligned with what we thought here. So look, I think we've got most of the votes in now.
Okay.
I'll just end the poll and share those results. So Steve, most people believe that office space would have been the hardest hit asset class during the pandemic. I mean, what's your
Mm,
feedback
I'd
around?
have to disagree with that consensus, because offices could work remotely in the majority of cases. So their businesses, whilst affected, if you're working in an office environment, you can work, as we've found, particularly through COVID, you can work it from home or you can work from the office. So I think the retail sector has been the hardest hit. I mean, when you shut a shop, and other than online sales and online income, there's nothing else you can do. So, in my opinion, they were certainly the hardest hit. The hospitality industry, clearly, but small retail, definitely the hardest hit, without any doubt. Office space, yes. I think moving forward, though, it's not just about the impact of COVID on office space in the COVID period. It's more the impact that it's going to have moving forward in terms of vacancies, where people have learnt to work from home, and in doing so, there's a saving both for the employee and the employer. So that one here. And industrial, again, I agree. I think there was a 0% for industrial, and that's pretty close to the mark. The majority of industrial uh, businesses worked all the way through COVID and were very, very minimally affected.
Mm. And that is interesting. So, I mean, you look at retail, and a lot of retailers had to move to online. I think it's going to build a lot of resilience in those businesses now, having to shift. But some of those retail stores might not reopen. We know that that's a reality. But Steve, I want to dive a little deeper
Sure.
into retail. So, I mean, what have you sort of seen out there in terms of things like vacancy rates? Are we seeing tenants moving out in droves? What's the pulse on the market at the moment in that
Well, our
retail
own
segment?
research shows that the vacancy rates for retail are around 6%, 5 to 6%, which doesn't sound very high, but when you consider the number of retail stores, it's obviously a lot. But that's we've seen that decrease over the last few months. Um, did you want me to talk about the industrial and office vacancy rates as well?
Yeah, we'll get into that, but I want to dive a little further into retail from, I guess, are we seeing stock in the market? Are we seeing, um, a lot of demand from tenants as well? I mean, what are you really seeing out there?
Look, we're seeing the retail vacancy rate reduce slowly. We're seeing take up now of retail space. Obviously, there's negotiation. Rentals haven't really dropped, but there's a bit of rent free and those sorts of things being offered as incentives to get retail people back into shops.
Yeah.
And yes, it's we're certainly leasing and have leased a number of retail premises the last, so let's say, 2.5 months on a fairly regular basis.
Yeah. Does it present a good investment opportunity for people at the moment if they can find some good retail spaces? Is there much stock in the market for people?
Oh, look, that's one of the problems at the moment. We don't have a lot of stock. We've got plenty of investors and plenty of owner occupiers out there, but the stock levels are very low. And this is driving, and we'll probably come to this a bit later, but driving the market moving forward into the balance of 21 and into 22.
Mm.
The supply and demand equation is really going to have an impact on prices over the next 12 or 18 months.
Yeah, and I think we'll touch on that as well. Now, I mean, the majority of Tsimos, I guess, property that we're managing here from an industrial perspective.
Yeah.
Um, Very interested in your commentary there. I mean, you mentioned very briefly that we didn't really see an impact to industrial. So, talk us through 2020 from an industrial
Well, we're already
perspective.
seeing it, Soren. To be honest, it's quite incredible. The demand for warehousing and manufacturing space is very solid, particularly from owner occupiers and investors. But we're leasing pretty much any industrial property we're on our books fairly readily, and the impact on rentals has been zero. In fact, we've seen rentals increase over the last 6 months. Believe it or not, it's what's
Yeah,
happened. So the demand again, it's a demand supply equation. And we're seeing some, in fact, record prices. There was an auction which one of our colleagues in the industry had last week in Clayton, where the reserve was something like 900, 950, which is about where I thought it was going to sell for, and it sold for 1.45. So, I mean, that's an
yeah,
incredible result in this market, driven by supply demand and driven by
yeah.
very low interest rates.
Yeah, and I mean that's a really good point that I want to talk about at the end, which is obviously the cost of money at the moment is very, very cheap in terms of interest rates and bits and pieces, which obviously makes borrowing power larger and then prices people can actually attract into that market. But the key point there being, Steve, that you're seeing the perspective of where a price should be at the moment and the market actually driving that price a lot higher
Yeah.
in terms of
That's
things. So
exactly what's happening, and certainly that sector is very strong and very solid.
yeah, fantastic. Well, and also very positive for our economy here in Australia to see
Oh, absolutely. I mean, just
industrial remain strong.
as a brief aside, I think as our relationship with China deteriorates, and I think it will over the next few years,
Mm,
what a great opportunity for the federal government and the state governments to introduce incentives to bring back manufacturing into this country. And I think that's what will happen. It won't happen overnight. It might take a decade or 20 years, but I think manufacturing is going to bounce back slowly because of the fact that our relationship with China is on such tenterhooks.
mm. And I mean, and it's those sort of market influences that are then going to drive fantastic growth in that asset class, and also
Exactly,
obviously
exactly right.
new development opportunities for investors in that class as well. So look, Steve, I mean, that's retail, that's industrial, office space, which in our poll was seen as obviously the hardest hit in that time. What have we seen from our customers, our landlords and our tenants in
Well,
that
just
office space arena?
if I just go back very briefly to industrial,
Yeah,
our vacancy rates in industrial are under 2% at the moment. So this is our own research, under
yeah,
2%. So that's a very low number. And that's given the demand and supply issue. Office
yeah,
space, well, there's two aspects to office space: the suburban office space, which we generally deal with, and the CBD office space. Suburban space has been affected, but not as much as CBD space has. We've seen vacancy rates sort of, as I said to you, around about that sort of 6-7% on suburban stuff, but it's being taken up. We're seeing a lot of offices being leased now. And suburban space is I'm quite comfortable with where it sits at the moment. But the CBD, and this is research I've looked at on the internet and through other agencies and what have you, the CBD market is going to struggle, I think, for a number of years because many businesses in the CBD have now realised that they don't actually need 4 floors of office space. And if
yeah,
they're paying $1 million a year in rent, they can pay $500,000 a year and have staff work from home. So there's a saving for the employee of time. There's a saving for the employer in terms of parking costs, etc., and driving in and out or public transport costs, and the employer obviously there's obvious savings. So what will happen is I think a lot of particularly big businesses in the city will tend to divest themselves of some of their space, so
yeah,
that will create larger vacancies. Hence, there'll be probably, if not a massive, not massive, if not a reduction in rent values, certainly unlikely to see an increase in rental values for a number of years to come there. That's how we
mm,
see it. I mean, I went to a breakfast the other morning with where the chief economist of the ANZ Bank was there. They occupy 3 entire buildings in the CBD, and they're now contemplating getting rid of 2. So that's an
wow.
indication of what's going to happen potentially.
Yeah, and obviously, as you were saying before about supply and demand, as that supply floods the market, then the demand
Correct.
will
Yeah.
drive those price points.
But the other,
From a
the
sub,
other, the other issue there is, of course, that uh, as the number of people going into the city reduces, those retail businesses in the city will also
yeah,
struggle. I mean, they're struggling now, and I think they'll struggle for a little while longer,
mm,
quite
yes,
a while longer.
and look, obviously, fingers crossed that we don't have any more snap 5-day lockdowns that really hurt in terms of keeping that momentum up and people coming back into the city. So,
Well,
Steve,
let,
I mean,
let me say firstly, if I may, I wish Daniel Andrews well in his recovery from his accident. Having said
yes,
that, there's no guarantee he can't pull the trigger even from his hospital bed.
yeah. Very good. Now, let's talk about suburban office space there, Steve. So obviously CBD, we get that, and I mean, I was in the city recently. It's actually great to be able to get a park, but also a little scary the fact that you're not competing for parking in the CBD
Yes.
anymore. From a suburban perspective, I guess looking at that from a rental standpoint, what have you seen? But also as an investment opportunity at the moment for some landlords out there that might be looking to enter the market or grab another property in that process. What are you seeing from an office space suburban?
Look, in terms of suburban office space, if you've got an office space or a building that's near transport, near retail, and offers uh, ease of parking,
Mm,
you've got a property that will let fairly readily,
yeah,
and that's what we're seeing. People who own businesses and work from home and then move the business to an office space, they generally tend not to go back home again, and obviously their businesses hopefully would grow. So if somebody leases office space in the suburbs, they generally live 10 to 15 minutes away by car. And that we've
yeah,
seen that space is still being taken up. The demand is still there, and I think it will continue to improve. And in time, I think suburban office space will become a great investment because people literally don't like going into the city, and
mm,
it's difficult to do so, and it's time consuming. If you live in Frankston and you work for the Commonwealth Bank in the city, you're talking about 3 hours a day commuting. I mean, that's a long part of a lot of your day. And then you've got the cost of commuting, and you've got the cost of parking your car and all that if you're driving in. So, yeah, I'm bullish about suburban office space. I think it'll continue to recover very well.
Yeah, so some of the conversations I've been having about, businesses looking, certainly even larger businesses that might have about, 500 to 1,000 staff, thinking about pockets of offices
Yeah,
coming out and
yeah,
distributing their workforce into the suburbs to avoid that commute and
yes,
also support people to still collaborate in that hybrid way.
exactly. Yeah,
They want to
and
encourage people to
that's
do that.
been
So it's really
happening.
interesting.
Yeah, that's been happening for years, but I think it's going to be accelerated now as a result of the COVID pandemic and the way that businesses have adapted and changed and looked at their businesses and their staff.
Absolutely, absolutely. So I guess to round all of that up, Steve, retail, you're starting to see that come back, but it's still a bit interesting for some of
Mhm.
those people coming back, certainly in the CBD area as well. Industrial's the best performing in your perspective,
No
and
doubt, by a long way.
yeah, office space certainly something to watch out for. But if you're an investor in the market at the moment and you've got some money burning a hole in your pocket, where would you be looking in terms of your investment opportunity at the moment?
Oh, look, I think I'd consider all three sectors. I don't think there's any particular one. I mean, obviously industrial in terms of longevity of tenant and uh, certainty of releasing a property. Industrial at the moment is probably the strongest by a street. So our yields now on industrial properties are 5%, so and in some cases even less, which is as low as they've ever been in certainly in my history in commercial property. So, but still, when interest rates are at, sub 1% and what have you, 5% yield on an investment property is pretty good.
Yeah, and also a good opportunity for those who might be looking to move or change up some of their portfolio
Yeah.
where there's good money in the market. It might be a good time to
Mhm.
look at your property as well and see what can happen based on that story of the warehouse the other day. So Steve, let's move on from the opportunity now and let's talk a little bit about for those landlords that are out there. Obviously, we're now coming to the end of JobKeeper. I'm not sure of the exact date, but you can let us know that. But what are the indicators or barriers are there for landlords charging full rent again? We had to move short, sharp, and fast in terms of supporting tenants to stay buoyant, I guess, through some of the COVID lockdowns and bits and pieces here, certainly in Victoria. But what are those indicators or barriers that landlords have at the moment to really getting full rent again?
Well, technically speaking, come the 28th of March, JobKeeper finishes and hence the rent relief scheme finishes as well. Now, there will be some businesses, not many, but some businesses that may still struggle,
Yeah,
particularly in the retail and hospitality sector, moving on beyond the end of March.
yeah,
And that's something that landlords and tenants will need to negotiate outside the Act because the Act will be no longer, well, we're assuming the Act will no longer be extended. There
yeah,
might be, and there's talk in the at federal level that maybe certain sectors might still be able to get JobKeeper. It might be the hospitality industry, which is good for
yeah,
the landlords because then they can start looking at getting full rent. But in our case, as I said earlier, 90% of our tenants, more than 90% of our tenants are paying full rent, and in some cases retail as well.
yeah,
Certainly all our industrial and what have you, and office space seems to be back. So there really should be no reason why, as of April 1 or 29th of March, the tenants shouldn't be paying full rent. But again, there will be a small sector and small number of tenants who, for one reason or another, legitimately will continue to have a reduced income and without JobKeeper might struggle for another 2 or 3 months.
yeah. Yeah, so it's still a little bit. I mean, obviously, when we get to that date, we'll start to see a little bit more. As we mentioned
Mm.
earlier, it does change week to week. Now,
Yeah.
Steve, we had a really good conversation because I was actually quite confused at deferred rent, waived rent, how that all works in this scenario. So, 29th of March, landlords having full rent or the ability to charge full rent again based on legislation.
Yeah.
How does it work with the waived or deferred rent
Well, if you've
that come in
negotiated,
during that
well,
period?
in most cases, you would have negotiated with the tenants, and let's say that the landlord agreed to reduce the rent by 50%. Well, 25% of that reduction would be considered purely a gift from the landlord to the tenant,
Okay.
non recoupable, and the other 25% would be considered a waiver, in which case that 25% that the tenant hasn't paid would be paid back over a period of between 12 and 24 months. after the tenant has started to pay full rent, or indeed when the tenant's happy to start doing it, but a maximum of 24 months. Now, in some cases, some of our tenants have said, look, what do we owe you for the waived rent, and just paid us in one lump sum. Some cases it's 6 months, it's 8 months, but it's a negotiable thing. But that's all happening. So there will be some sort of clawback for landlords. But if I can just sort of go a little bit sideways, I
Of
think
course.
one of the things that has disappointed me with the legislation is that the consideration for our landlords has not been there by the state and federal governments. Essentially, they've told they've told our landlords they must forego 50% of the rent minimum. Obviously, the waiver is another issue, um, and they've had no relief or no assistance from the government, or very, very little. Whereas the tenants, and I think it's been great, have had JobKeeper, they've had grants, um, mortgage deferrals, interest deferrals. So, I mean, they've been helped, and it's been great. But that's really kept our economy going. But coming out of it, I think I do feel for landlords because they've lost money they'll never see again, through no fault of their own. I mean, and look, I'm not suggesting it's the end of the world for them, but I think that a lot of our landlords are self-funded retirees, and all they live on is the rent they get. And when you halve that, it's a bit like you taking a pay cut of 50%. I mean, it's extremely painful.
Yeah, and obviously hurts the lifestyle there. You mentioned the other week that there were some things, and we actually had a question come through as well about reducing land tax. Now, was there a commentary there in terms of the
Oh,
supports that have existed? Is it anything worth
just
writing home
the
about?
state government reduced land tax for certain landlords who have offered uh, rent relief to tenants. It's not those who haven't offered any. It's only those who have actually offered rent relief to tenants, and I think it's a 50% reduction. But in most cases, it's you know $1,000 or $1,500 or $2,000. When the tenant's paying 50 grand a year or 60 grand a year, so it's not a big impact. And
Yeah.
I mean, it's still a help, I understand, but I mean, if you compare it to what the businesses are getting and landlords are getting, it's chalk and cheese.
Yeah. So I think the point there then, Steve, is to really stay on top of, and a lot of the work that Tsimos does in terms of that negotiation, working with tenants and making sure you're on top of how quickly the tenant can start to obviously, full rent is important, but also start to bring some of that deferred rent back in as well,
Absolutely.
to support landlords through that
And that,
process.
and that, by the way, is an added workload for our team here because now we've got to sort of calculate that and make sure we collect that every month or whatever the agreement is. So, but yeah, we're doing all that, and it's starting to flow through now.
Yeah, which is absolutely fantastic. So, look, the next part, Steve, is one of the things that we really wanted to do from the audience as well is you mentioned there that the different workloads or the different things that have been important for the team to focus on at Simos. What I'm also interested in, though, is from the audience's perspective. Now that we've lived through COVID, what's the most important thing to you in terms of working with a commercial? Just going to launch this poll
It's been
now.
an interesting one, I'm sure.
Hang on 2 seconds. Let me just run the second one. Launch poll. Yeah, just to see, I guess, what was really important for everyone during that time. And we've got some customers on the webinar today, but there's also some new faces as well. So I've just put that poll up there. So what's the most important thing for you guys now or what are you looking for the most from your commercial property firm? We've had one. Consistent communication, seamless releasing. Very balanced for you on this one, Steve.
Oh, okay.
Um,
Well, I
right, we
can't
just.
answer this because obviously
Well, it's just interesting to hear
bias.
what people felt the most during this time and what was really important. All right, I'll share those results now. We've got most of those people back. So there we go, Steve.
Okay.
Um, advice on values or investment opportunities, the leading one there.
That's
Um,
interesting, isn't it? And that's, I think, just a reflection of the supply demand issue. And look, our landlords are potential vendors, but at the moment, our landlords are most of our landlords are potential purchasers. So obviously, advice on investment and purchasing property. I think that one of the things that um, we we pride ourselves on consistent communication, but during this period, it's been a challenge, and we've been very disappointed that we haven't been able to hold up that standard of communication with our landlords and our tenants because of the workload. But that's all now recovered, and we're back in doing that sort of stuff. But other than that, I think, yeah, I would have thought from a landlord's perspective that they like to be talked to as often as possible, and we certainly try and do that.
And hopefully these sorts of mediums, I mean, we're very welcome to
Yeah.
everyone's feedback as well if this is useful. Obviously for us, we'll focus on things like sales value and investment advice in some of the following webinars, but very open to feedback in terms of the things that you guys are looking for. So,
Oh, look, may I say that if any of them would like to have a one-on-one Zoom chat or a meeting with me or any of my staff and my team, please get in touch anytime. We're more than happy to help and discuss any issues or problems you may have. And if you're not an existing landlord and you need a bit of advice, happy to help as well. So, ring me personally, email me, or any of our team you'll find on our website.
fantastic. Now, we're also going to be sharing this, so the Tsimos YouTube channel is live. We will be sharing our webinars and some bits and pieces and snippets there. So I'll send an email out to everyone from Digital at Tsimos, just communicating how to find access to this recording. And as Steve said, certainly reach out, whether there's some questions or some feedbacks or some things that you'd like to focus on or
There's
us
just
to
a couple of
focus on in this
questions
show.
that's just have come through from Moshe. What can be done to reduce land tax? Unfortunately, nothing. And in fact, from what from the information I'm getting through my association with the state the state parties, is that in fact next year you can expect a substantial increase in land tax by the government. And anonymous attendee, what yield can we expect from retail and office space? Somewhere, depending on retail, can vary greatly. It can be anywhere from 1.5% to
Mm,
7%, depending very much where it is. Office space, sort of 4 to 5%.
fantastic. All right, thank you, everyone. Keep well, and we'll keep you informed of the flow of it. And thank you so much, Steve, for taking the time to talk us through.
Oh, it's always a pleasure, Soren, and once again, happy anniversary.
Thanks, everyone. Have a wonderful day.
All the best.